It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, National Underwriter for Old Capital. And Heidi ho, it is Michael Becker. How are you?
Paul, doing pretty good. Just picking my jaw up off the ground after seeing some of these deep prices, some of these deals are trading at.
Is it not just crazy? I mean, you've done this for a long period of time. You were a banker for a long period of time, and now you're an operator of multifamily properties, 10,000 plus units that you guys have bought. Is it? Are you starting to get the old man theory going into these deals right now? That I remember back when it was at $27,000 a door. I don't think I can pay, $200,000 a door for that thing.
Funny you said that. I just did that this morning with somebody on a deal. So I was joking with you. I'm turning into Mike Oxstein. Our buddy Mike is a guy that's been doing this for 100 years, So I'm starting to relate to him a little bit more. I think the older I get.
So what is going on out there? We joke around and we kind of figure out when we ask Michael, he's where the rubber meets the road, and we do the debt, and Michael does the operations of multifamily properties in the Texas area. And so he has a great perspective about, really what's going on. So, Michael, you and I have talked privately about how crazy these numbers are on properties. And can you give me one or two examples how crazy it's gotten if you have been a seller of properties recently?
Yeah, I'll protect the names or keep the names confidential, protect the innocent here. But yeah, we've been basically selling a few deals here lately, and a couple that are ours, and then we have some that some of our advisory clients have that. So, but I've been kind of running point on the dispositions, and like, holy crap, it's aggressive right now. There's very little inventory, as we kind of talked about starting out 2022. There's been just not much inventory. So, and then there's a lot of capital, and it's all coming to Sunbelt multifamily, and Dallas and Austin, and San Antonio, kind of right in the middle of all that. So we've just been seeing a tremendous amount of interest. So we've had a couple deals go full marketing process, and one deal kind of get preempted along the way, even though I had a little mini process. The one we kind of ran full on, we ended up getting like almost 50 tours on pull for about a 5-week period. And normally if you get, say, 20 to 25, you're happy. So, in excess of twice of what we normally are getting, we ended up getting like 32 offers on it. And we had I think 13 make the best and final because they're all bunched on top of each other. And then it moved, 5 or 6% during the best and final process. So it's been aggressive to say the least. And, whatever the range was, we well exceeded the top of the range on this deal. That was nuts. And then the other one kind of got preempted. We had a couple. The one I just talked about is kind of more like a core plus deal. So no real value add to it. The other one we had one of clients owns was more of a value add deal. And that had, I think eight groups try to preempt it. So we kind of ran like a little process within the process, and ended up getting about 10% above the top of the range at the end of the day, Paul. So like 10% on top of the range. So when you get a value from your broker, they give you kind of low, mid, high, or, market strike premium. You might call it one of two ways, kind of low, mid, high, and usually trying to get between the mid and the high. In this case, it went, 10% above the top of the high. So it's just crazy. These cap rates are all kind of in the low twos. It's aggressive, to say the least.
I mean, that is super aggressive. And you said something maybe that I don't understand. Run the process. What is really run the process when it comes to multifamily? And, why didn't you try to do this off market, and why did you have to run the process?
Yeah. So when you sell on deals, you can sell it kind of a couple ways. Typically you could either sell it off market. Usually there's a broker involved. They bring you one buyer, then you negotiate back and forth and, kind of just, set a price and terms and go forward with it. Or you can formally engage a multifamily listing agent, broker. They, sign a listing agreement. They blast it out. They put together a package, an offering memorandum, OM is what they call it. They go out to the whole distribution list. They field questions. They give tours. They have a call for offers date. So, on Wednesday, the 25th on Wednesday at 2:00, all the offers are due. They get submitted. You kind of get them all compiled. You review the top groups, and you invite the top handful to the best and final. Usually it's like, 2 to 5. In this case, we had 13, which is way too many. and then they kind of resubmit terms and price. So it's a whole gamesmanship thing. And, price typically goes up, and then sometimes you can do the best and final, et cetera. In this case, got an offer, picked the group we wanted, had an exclusive counter and countered them. So that's kind of what we chose to do after the best and final. So there's a couple of different game theories and things like that around it. But yeah, went aggressive.
Yeah, no doubt about that. So tell me a little bit about how you vetted these folks out. I mean, how do you vet potential buyers that want to buy one of your properties? Do you do a call with them? Do you talk to their, somebody that's going to vouch for them? I mean, how did you guys get a comfort level with some group maybe that you've never heard of before that they're going to step up to the plate and get stuff done?
Yeah, just kind of a little bit of everything, Paul, you just kind of mentioned. So you typically send them a questionnaire. So you ask them questions about, how they're underwriting, the background, some assumptions there on their capital improvements, their debt structure they're going to go with, how much sensitivity are they underwriting for, interest rates? Because we're in as we talked to JP here recently, we're kind of in a rising interest rate environment for the near term. So, if the rates move 50 basis points, is that going to blow your deal up? Basically trying to figure out how sure are they in doing the deal. Usually you'll have a call with the top handful of groups, kind of, ask them the similar questions as on the questionnaire. Then you also have, lean on the broker quite a bit. Like who are they? What have they done in the marketplace? Who have they bought from? Are they longtime owners in town, which you probably know, or are they new out of town, which is kind of every freaking buyer today is new in town, seemingly. Or most of them are. That's why us guys have been around the block are having a harder time buying because there's so many new participants in the marketplace. So then you go to usually they'll call their counterpart in whatever market they came out of, come out of California or Arizona or whatever. So your broker team will call his counterpart in that area and kind of, vet them and see how legit they are, et cetera, history. And then, just kind of really, really make sure you're doing your best to kind of, tighten up the terms as tight as possible. So obviously price matters, but, when are they going to have an access period, no access period? When does earnest money go hard? Where's their debt? Where's their equity coming from? If something happens to one of the two, can they go solve their own problems? Stuff like that, right? Those are the types of things that we're kind of working through.
And how long was that deal out? That the one that was fully marketed out, was it out for
almost 5 weeks, I think.
5 weeks?
That's pretty custom. Yeah. Maybe 30, 35 days, something like that.
All right. So now you pick a buyer in the horse race. Now you're going to contract on the deal. Do you give them look at the property, a free look to have their due diligence team take a look at it? Do you ask for hard money up front? Tell me a little bit of things that happened to you and then that you're doing to other folks.
Yeah, sometimes you get an access period, sometimes you don't. Today, we're trying to not have access periods because that's better for a seller, worse for the buyer. So they basically toward the deal and they don't get any more paper besides what was kind of given to them during the bidding process. And then they don't get their diligence material until after they sign the contract. So that's kind of about as tight as you're going to get. We're giving out, we always make sure we get a current title commitment pulled. We incorporate the existing survey and the title commitment, and then we give them the title commitment as part of the PSA negotiations, contract negotiations. PSA stands for purchase sale agreement. So that's kind of like jargon in the business. So they get their PSA and they have to make title objections as they're negotiating the PSA. So you don't want to have like a title objection period post contract as one more out. Usually we're trying to get it where the only outs are major casualty. So like a major tornado or massive fire burns down, say 10% or more of the value of the property. That's kind of an out. If it's under 10%, they're in it. If it's over 10%, they have an option to get out of it. And seller default, meaning that if, I don't do what I'm going to do, I don't sell them the property, then they can get their earnest money back. But short of that, we try to get it to where there's basically no outs when they sign the contract, short of those two things. No financing contingency, no inspection contingency, no operating metric guarantee. I don't have to maintain a certain occupancy or collection level or anything like that. So it's about as tight as it can possibly be, Paul, right now.
But what happens, on today, it's fantastic because occupancy is high. But let's say that we fall off in the middle of this period from the period of time the contract signed to the time that they have to close. What happens if occupancy falls off, or what happens to collections fall off? Is that your problem?
It's the buyer's problem. Yes. Today, yes. If you have those terms I'm talking about, yes. Fortunately or unfortunately, I don't know how you want to look at it. That matters a lot if you're getting a Fannie Mae or Freddie Mac loan, and the debt funds don't give a shit. So they're just going to fund no matter what. So your loan proceeds aren't necessarily at risk per se, or that's my perception, Paul. Maybe you're closer to that than I am, but I mean, it seems like these debt funds will paper right over it, and that's what's getting all these buyers to be aggressive and driving the cap rates down and pricing up.
What are you hearing about debt funds these days? I mean, we're talking about you selling properties now. Unfortunately, or fortunately, you're gonna have to go out and buy some properties right now, and so then you become the guy that has to bid on these deals. Again, you've done this for a long period of time. I mean, how challenging is it? How many steak dinners do you have to bring these listing agents to? How many ball games? How many Masters golf tournaments you got to bring them to? What does it take to get in front of these folks?
Well, let's see. I had dinner last week. Had a dinner and then went out and shot birds. This week I had dinner last night. I got a dinner tomorrow night. So yeah, my liver's probably more shrivel than it should be, right? I mean, you're constantly having to get out there and go do stuff, right? So it's relationship business. Got to help anyone coming in the cold into the market in this environment. I mean, it's got to be difficult. It's very hard for a guy like me. It's got to be, extremely difficult for someone coming in cold. Yeah, that's tough, right? So, but I mean, a lot of it's leveraging what you got and, using what you have at your disposal, your relationships, leaning on, third parties to get credibility. Like I was saying, these guys, one of the groups are coming in from out of town. We don't know who they are. So they have the broker in their home market call the broker in Dallas or Austin or whatever and say, hey, we vouch for this group. They've done X number of deals, et cetera. So that's a good kind of leg up and gives you some, credibility kind of transferring from the broker shop out of Phoenix or LA or, wherever you're from, or, like I said, leveraging a guy like yourself, Paul, that if Paul's well known in Texas and you're trying to buy a property in Texas and Paul's going to finance it for you. Paul says to the broker that's selling the deal that these guys are bankable. I betted them and they're thumbs up. Then that means a lot to him to go tell his client that, hey, they're good on their debt, so that stuff like that really, really helps.
Tell me, a lot of these people who listen to this podcast are not at your level. They want to be at your level, but they're just not at your level. Any tips, words of wisdom, anything that you're seeing right now in the marketplace that if you're trying to come into a Dallas Fort Worth marketplace, is it good to come into a large metro marketplace, whether it's Phoenix or Tucson, or is it better maybe to look at some of these secondary, tertiary markets?
You can look at it both ways. We did a handful of deals in a market called Tyler, which is about an hour 45 east of Dallas, maybe by car. Good secondary market, but it's smaller, it's a little less competitive. You get a little higher cap rate there. And that's a pretty good one. But you go to some of these other like real small markets, maybe you got 20,000 or 30,000 or 50,000 in the area. I mean, you just don't have as much opportunity, one. And then it's great today because they're like everyone's getting priced out of the Dallases and the Austins. So they're going to Waco and they're going to Temple and they're going to some of these other smaller markets. There's plenty of liquidity today. But, if stuff kind of, corrects on us, backs up a little bit, there's always going to be, I say this, so there should always be liquidity in a Dallas, much more so than in, Temple or Waco, right? So there's always a way to get out of Dallas, and maybe there's not a way to get the hell out of Lubbock or some of these other kind of smaller markets. So that'd be the one thing I'm kind of a little leery of, is kind of how much liquidity is in the market, because that, today is great, but tomorrow it might not be that way. One, and then two, you just don't have the diverse, large employment base. You get a little bit of supply. It can really shock the market quite a bit out of these smaller places. So those are the things to be careful of. But I mean, there's always deals everywhere, and just kind of that might be a competitive edge that you can not have to beat your head against the wall and get so damn aggressive on like everything you're having to do in Dallas and Austin right now.
We talked about having markets back up a little bit. And I think what you're saying is that interest rates go up, cap rates go up, collections of rents, stay the same or maybe go down a little bit. Give me about 2 or 3 things that makes you not sleep at night. What are you seeing out there? Is there any feelers that you feel, any tremors that, with interest rates rising? We had JP Conklin on the other day talking about where interest rates are going. Is there anything that in your perspective that you can't sleep at night with?
I'm about not sleep at night, but yeah, I mean, if rates really do go, which I'm in his camp, I don't think they really run too hard, but they're going to go up. You're going to get negatively geared. You're probably already there, meaning that your interest rate's going to be higher than your cap rate walking in. So that's all good if you're doing a value add deal and you can move rents $200-$300, or you're seeing 20% rent growth or 15% rent growth. But what happens if your rates we've been paying have been in the kind of the mid to high twos, now all of a sudden 4 to 5%, and your rental rate growth goes from 15% to 5%? I mean, I think at some point cap rates have to widen and go up a little bit, because you can't that math just doesn't work. So, and if I think we see slowing when we see rent growth slow, that's when I think we're going to start seeing some issues with some of these pricing kind of backing up on us a little bit. If we see material rent growth slow, the cap rates have to expand a little bit. That's what I think. I've been saying that stuff for a long time, and they always keep going down. So I don't know. I don't know anymore, Paul.
We talk about it's an incredibly unfair business when you're up and competing against guys like Michael Becker and his group over at SPI. But also, too, Michael has a couple of phrases the one I like is "don't buy in the hood." And you see a lot of Class C properties or B- properties that are in demographically challenging economic areas in your community, and we see a lot of value added plays historically on these properties, and a lot of syndicators have been drawn to that because they go in there and they fix it not just once, but 2 years later they fix it twice, or somebody else comes in and fixes it twice, and then that group sells it 2 years later, and they send it, fix it twice. We've had the deal rehab 3, 4, 5 times. What's your take right now in the state of the C and C plus market for the value added?
Yeah, I think I saw a deal that's on the market. I won't name it. Workforce housing in suburban Dallas. I hit the paper that day because the tenants are suing the landlord because he's not keeping the place up. They didn't have heat in the winter storm that we had here a few weeks ago, and a bunch of issues like that. And I sent it to the affiliate, one of the guys over at the broker shop selling it. He's like, well, I guess this is what happens when us brokers keep squeezing these buyers to pay higher and higher prices. They got to starve the deals of capital to be able to make these returns. And that's kind of what's, I think, been happening. People come in with the business plan to go do these value add, and then they walk in the thing. They've been seeing pretty good rent growth. And so they never actually spent the damn money, Paul. They've been paying their distributions out of kind of the cash they had on hand, giving it back. And then they're able to, the market's so damn strong and so liquid, they're able to sell the deal and make all these, 5 years of returns in 2. And that's been happening 3 turns in a row. Right. So we're on the 4th version of this. And, some point, you kind of heard the term bag holder. Some point, someone's gonna be holding the bag. And I think that's a lot more true in the workforce housing space than it will be at the top of the grade, nicer assets, because those are more institutionally owned and managed, freshly managed, and people put capital in them. You don't have the same capital intensive needs that you would on a 50-year-old building, on a 5-year-old building, for example. So I think those, especially then the worse or higher crime, lesser located deals are even more at risk, in my opinion. But they keep going up for now, and one day that'll back up. So I think I'd be really careful what you buy and do a really good physical inspection. So I'm sure there's years of money that should have been put in these deals, and they just kind of put a little lipstick on it and never actually took care of the issues.
Yeah, it's funny you should say that, because, and that's what we've seen recently in the last couple of months or so, is that the syndicators, these are general partners that have got into it that may have been IT professionals or then, something to do with another industry, and that they've come into the multifamily industry that they really have had no experience of maintaining a large asset or dealing with tenants or dealing with the city hall or with the inspectors or dealing with all the distributors that are trying to bring parts to your property. And so they sometimes they just become overwhelmed and that they have troubles trying to do their job. And then there's just kind of, as I say, just a lot of bullshitters out there that have gotten this business and don't, just like you're saying, is that they promise these unbelievable returns to their limited partners. And And it's really just based on starving the property, not putting real capital back into the property, there's replacement reserves. That's just a minimal amount, but these people should be putting in thousands of dollars to keep the asset or the collateral going. And they haven't been doing that. And they've just been rescued, like Mike says, with with all boats rising, with higher values every couple of years onto these properties. But some period of time, that's going to stop. But one of the things that kind of want to turn the tables on is a check or being found out by your lender what kind of condition the asset is. In this case, I read that article that was in the Dallas Morning News, and they pinpointed the ownership group that owns that property, and they made them a pariah in the industry that they haven't been putting money back into the property. Again, I don't have full details, but you don't want to be that guy. And again, you don't want to be that guy with Fannie Mae that if they come onto the property and they need $600,000 worth of work to be done on that property, you haven't done it, and that's been a year or two that you were just hoping that the value of the property was going to rise without putting money in. You're going to go on a check, which means that you're not going to do business with Fannie Mae or let's say Freddie Mac in the future, and then you're done as a syndicator. So don't starve the property. Continue to put money back into the asset, make it a good place, because if you don't keep Fannie Mae or Freddie Mac happy, those U.S. taxpayers that I call tenants in the property, that will have a beeline to Fannie Mae and Freddie Mac to turn you in, to tell you that you're not doing a very good job. Michael, anything else?
Nope. Yep. I mean, I think right now the debt funds don't care, and but everything's great until liquidity gets out of the market, and they're providing a lot of liquidity. And then when they get out of the market, it'll be like 2020 when Fannie and Freddie were the only two lenders in town, for the most part, right? They did the vast majority of the deals in 2020, and they do care. So I think just be careful, right? I mean, it seems maybe a little toppy out there. I don't know, so it's hard to tell exactly, but I mean, we got great fundamentals. We're still going to be doing deals. We got to just kind of continue to stay disciplined, comb through a bajillion deals. I know I get pressure all the time to put more opportunity out there, and we haven't done as much as I wanted to. Just trying to be careful and cautious, not to mess this one up along the way, because it's it's aggressive right there, and I've just witnessed it firsthand on the good side of that aggressiveness, how much liquidity and demand there is for what we have. So if you own a bunch of apartments, you're probably richer than you think you are. That's the good news. If you're trying to buy in, it's a freaking knife fight out there. So just be prepared. Get your ducks in a row. Make sure you have your debt lined up. Get your references. Get some good people to kind of help you along the way. Give you some credibility, and that'll go a long way to help out there. So yeah, it's just be careful today. I think it's certainly very aggressive right now.
Very aggressive now. Good words of wisdom from Michael Becker. If people wanted to get more information about what you do, Michael, as a builder of wealth with SPI, again, what does SPI stand for?
Yeah, so our company's SPI Advisory, which is strategic property investment. So you can find more information if you just go to our website, Paul, which is www.spiadvisory.com. There's a whole bunch of information on there about our company, our portfolio, contact form if you want to get into the list or to get into our investor database and see future opportunities when we can kind of see through the field and try to find the right deal out there. Hopefully we'll have one coming up here in the not too distant future. That's kind of really the goal. So I think, just go to spiadvisory.com, drop us your information. Happy to, start a conversation with people we meet on the podcast.
And there's one more thing. The thing I think is unbelievable. Some of the advisory work that you guys do, and a perfect example is that one of those deals that we were talking about earlier, that was an advisory deal that you guys did. And can you just give a little bit of background on that and protect the innocent?
Yeah, I mean, this guy, we had two of these three. We did one doubled their money in about 2 and a half years, essentially. And the other one tripled his money in 2 years. And it was, or a little bit over triple his money. It's unbelievable. And these both were, one was a little bit of a value add, the double, and the other was just a core plus deal. We just bought a good deal at a good price, and holy shit, did he make a ton of money. I mean, it's unbelievable. I wish we would have bought it ourselves, to be honest with you, Paul.
But what did you guys do? I mean, what you advised them what to buy.
He had a 1031. So a gentleman out of California had a 1031. He actually ended up buying a deal in Dallas on his own. A little bit of a struggle for him, and then he sold it, made a little bit of money on that. And then we ended up taking that, and then we put him on a deal in Central Texas. He bought the deal right before COVID, and it just went to the freaking moon. So it went from he just absolutely crushed it on the deal. So it's it's unbelievable the amount of wealth for. He told me a funny story too. Like, I didn't realize this. He lives in California, and he was telling me how he bought it. He was in town in March of 2020, closed like a week before everything shut down. And he's like, I haven't been back to the property since we bought it. So he hadn't been to the property in 2 years. So tripled his money and hadn't been to the property in 2 years. That's unbelievable.
And we talk about tripling his money. What he'll make on that would be enough to pay for a Gulfstream jet. Am I right or wrong on that?
Maybe more. I don't know. Yeah, unbelievable. So he's getting 1031. We're going to buy him something big and pretty. It'll be good.
That's great. So great information from Michael Becker. Be like Mike. Continue to listen to Mike and some of his discussions. Let him help you play catch up with his knowledge about what's going on. Again, Michael Becker with SPI. We certainly do appreciate spending some time with us. I'm Paul Peebles. Have a great day.